Time now for hot picks, and our next guest has the Post-it note and Scotch tape maker 3M as his top pick. He says the company is accelerating product launches over the next 3 years, reversing years of stagnation. Joining us now is Jonathan Sakraida, Senior Research Analyst at CFRA. Jonathan, thanks very much for joining us.
Thanks for having me.
I know we think of 3M as Post-it notes, but there's a whole lot more to it than that, and now it's getting even bigger, you say.
Yeah, so they have dozens of product lines. They're heavily diversified, almost to a fault. Right now, they're trying to prune and pull back some of that portfolio to make sure they're best aligned for sustainable organic revenue growth. This last third quarter, they identified about 10% of their sales are on the potential chopping block, really exiting these slower, no-growth businesses to help that earnings growth trajectory overall. We think this quarter really cemented that it isn't a turnaround. Many years of stagnation, both on sales and margins, seem to be entering the rearview mirror.
And what are some of the companies they're getting rid of, and where's the focus turning to?
So they have not yet identified exactly which of those underlying business units are up for sale. They really lean towards or mentioned that these are business units that they feel like they can't compete efficiently on, they can't innovate in, and that they would be better utilized with another company. That's how they worded it. And really where they're going to start shifting their growth is the trend we've seen across industrials is more and more manufacturers are trying to align with these more secular growth tailwinds that could be data centers, that could be infrastructure, electrical utilities, infrastructure. So I think more and more they're going to shift towards that to make sure they can, quote unquote, grow through the business cycle and not be so cyclically driven.
And which parts of it will benefit from the AI and the data centers and things like that?
So primarily they're industrial and more manufacturing facing product lines, not so much their consumer. I think consumer could see a lot more of that pruning. It's less profitable, less organic growth. I wouldn't be surprised if they spun that off entirely. There's not as much you can innovate when it comes to Scotch tape versus maybe some aerospace, automotive, data center market type businesses. So really, once again, they're going to focus on where they feel like they can innovate. And we see that mostly outside of their consumer business.
All right, we've got two more we want to get to. Eaton Holdings, what are you liking about that right now?
You know, Eaton is a very good sponge for a number of different mega trends we've seen across the market, whether that's aerospace, data centers, electric utilities. They're kind of on a periphery or satelliting a lot of these huge trends and absorbing that and capitalizing on it. The data centers right now, there's huge demand. Eaton Corporation is a leading marketer of power management systems within this space. Aerospace, we have the re-ramp of production from Boeing and Airbus really starting to pick up after many years of supply chain flops, quality control issues, et cetera. We've seen that start to enter the rearview mirror for them. So Eaton Corporation is very well suited to capture that ramping OEM-esque sales within power management of aircraft. So we really like its exposure to these markets, see above growth, the kind of growth you'd expect from a smaller name for Eaton.
Which is in this market right now. It's always nice to hear nice growth like that. Last one, Vertiv Holdings.
Vertiv has become a very popular name. It's had substantial growth in recent years. They're coming from a sub 10% operating margin business, and now they're growing towards 20%, the mid 20s. So the margin story has been quite significant. They're up almost 60% year to date, but quite justified in our view. The earnings growth trajectory has ramped up dramatically. Every single quarter, we've seen a lift to guidance and a beat. There's around, I think at this point, by our estimates, around 90% of their sales tied to data centers. So they're really a core beneficiary of substantial amount of AI infrastructure spending. And they're not sitting on their laurels, right? They're partnering with NVIDIA. They're staying very close to customers, and they're introducing a large number of products to make sure that they're staying close to the needs and where the market is moving. So they've really done quite well as far as execution and marketing position, and we think that's going to be one of the most attractive growth names within the industrial space.
How important is that to you when you see a company moving and jumping and making new deals with those companies?
Very important, right? Because it very quickly you see a number of competitors jump in the space and start taking up market share. So it's crucial that if they're going to maintain their pricing power and also being able to continue to absorb those high order rates, Q3 orders were up 60% year over year organically. That's an acceleration. Earlier in the year, there was concerns that there would be a cool down. The opposite has happened. And I think partly we've seen that with Vertiv because they are effectively capitalizing. So very important for them to be able to actually leverage this growth and not be kind of shouldered out by other large players, including Eaton.
Okay. On that note, we'll leave it there. Jonathan, thanks for joining us.
Absolutely. Thank you for having me.
Jonathan Sakraida is a senior research analyst at CFRA.